Hello everyone. Today I present the paper Conditional Mean Risk Sharing of Losses at Occurrence Time in the Compound Poisson Surplus Model, published in Insurance, Mathematics and Economics in 2023, a paper written with my co-author Michel Denuit. The central objective of this work is to revisit classical actuarial risk pooling by moving from ex-post redistribution of total losses to a fully dynamic framework where losses are allocated immediately when they occur. We embed this idea in the Compound Poisson Surplus Model, which is the canonical setting of collective risk theory and ruin analysis. This modeling choice is fundamental. It allows us to derive explicit formulas for surplus processes, ruin probabilities, and asymptotic decay rates, while keeping a clear economic interpretation. Importantly, the paper connects modern risk-sharing concepts such as conditional mean allocation and convex order dominance with classical actuarial quantities like safety loading, adjustment coefficients, and Lundberg exponents. Throughout the talk, I will emphasize both the probabilistic structure of the model and its economic meaning, how heterogeneity across participants is handled, how actuarial fairness is preserved, how timing risk emerges, and how pooling reshapes solvency over finite and infinite horizons. I will also discuss extensions to borrowing, interest allocation, and surplus sharing at maturity, as well as large pool asymptotics. The paper proposes a risk-sharing pool in which each reported loss is allocated instantly at its occurrence time, rather than aggregating all losses and redistributing them only at maturity, as in standard risk-sharing schemes. Allocation relies on the conditional mean risk sharing rule applied to mutually exclusive risks. This produces a closed-form expression for the contribution of each participant to any observed loss, where weights depend explicitly on individual claim intensities and severity densities. From a risk-theoretic perspective, pooling is shown to improve positions in convex order, meaning that every risk-averse agent strictly prefers the pooled account distribution. Infinite horizon default probabilities are reduced for all participants, regardless of the initial deposit. Over finite horizons, however, the picture is more subtle. When the initial deposit is zero, pooling can increase default probabilities because it accelerates contribution calls at early times, making participants more exposed to early shocks. The framework is extended in several directions. Borrowing is allowed when the pooled surplus becomes negative, with interest allocated among participants under a monotonicity condition called no sabotage. Terminal surplus or deficit can also be shared at maturity. Finally, asymptotic results for large pools show that individual risk can be almost fully diversified away under mild technical assumptions. In standard risk-sharing schemes, participants usually settle their own claims and reconcile accounts ex post at the end of the coverage period. This approach hides timing risk. Even if long-run balance is positive, early large claims may exhaust available surplus. In contrast, real-world insurance operations and decentralized insurance systems typically settle claims immediately once approved. This motivates the need for an occurrence time sharing mechanism. We propose to keep a static sharing rule, but apply it repeatedly at each claim arrival within a compound Poisson surplus model. This is conceptually different from dynamic allocation rules, where the sharing policy itself evolves over time. Here, the dynamics arise from repeated application of a fixed rule at random claim times. The framework also accommodates partnerships. A financial institution can provide liquidity when the pooled surplus becomes negative, absorbing timing risk, while an insurer can sell additional guarantees. This separation between internal diversification and externally priced guarantees is important. It allows us to isolate the pure effect of pooling from the cost of insurance add-ons. This slide provides a visual intuition for the model. On the left, typical non-life insurance, losses are valued and redistributed immediately at occurrence times. On the right, disability type insurance. Losses are evaluated only after durations, leading to delayed financial adjustments. In the proposed model, every shock triggers an instantaneous redistribution among participants. Financial stress is revealed continuously rather than being deferred to maturity. This continuous adjustment fundamentally alters solvency dynamics. Early claims immediately affect individual accounts through allocation, which is precisely why timing risk becomes central in the analysis. The figure also highlights that occurrence time sharing cannot be reduced to standard end-of-period pooling. The temporal structure of cash flows is entirely different, and this difference drives many of the results on ruin probabilities and surplus behavior. Each participant experiences claims according to a Poisson process with intensity lambda I, and claim sizes yik that are independent and identically distributed. The cumulative claims SIT therefore follow a compound Poisson process. Participants contribute continuously at rate Ci, defined as expected claims multiplied by 1 plus a safety loading parameter. They also pay an initial deposit KPI, which can be interpreted as membership fees or initial capital. The individual surplus process is contribution income minus accumulated claims plus this deposit. This is exactly the classical insurance surplus model applied at the individual level. All individual claim processes are assumed mutually independent. This assumption underpins the diversification results later in the paper. At this stage, the key point is that each participant, if standing alone, faces a standard ruin problem with their own parameters lambda size, severity distribution, safety loading, and initial capital. At the pool level, contributions, claims, and deposits are aggregated, producing a collective surplus process that again follows a compound Poisson model. The total claim count is Poisson, with rate equal to the sum of individual intensities. Each pool claim has a size yk generated by exactly one participant. Importantly, the pool severity distribution is a mixture of individual severity distributions weighted by their claim frequencies. This mixture representation is crucial. It connects individual risks to the collective process. This probabilistic structure allows to reverse engineer losses. Given an observed pool claim, one can compute the conditional probability that each participant generated it. These conditional probabilities form the basis of the allocation rule introduced next, and they naturally reflect heterogeneity in both frequencies and severities. Here we reach the core of the paper. For each pool loss, yk, we define components zk I corresponding to the part generated by participant I. These components are mutually exclusive and sum to yk. The conditional mean risk sharing rule assigns to participant I the conditional expectation of zk, I given the observed pool loss yk. This leads to equation 1, where each participant pays a fraction of the loss proportional to lambda I times its density at that loss size divided by the corresponding sum over all participants. Economically, this fraction is exactly the conditional probability that participant I produced the observed loss. Participants with higher frequencies or heavier tails therefore contribute more precisely at loss sizes where they are statistically more likely to be responsible. This allocation is actuarially fair, explicitly accounts for heterogeneity, and coincides with the conditional mean rule characterized in earlier work by Denuit and Denuit for mutually exclusive risks. Under pooling, participant accumulates allocated losses over time according to this rule, defining a pooled individual surplus process. Budget balance holds pathwise. At every claim, allocated shares exactly sum to the realized loss, so the pooled surplus always equals the sum of individual pooled accounts. There is no leakage or creation of capital through allocation. Actuarial fairness also holds. For any time t, expected pooled losses equal expected standalone losses. Joining the pool does not modify average payments. What changes is the distribution around the mean. Heterogeneity is fully respected. Participants with higher frequencies or heavier tails contribute more at precisely those loss sizes where they are more likely to be the originator. This preserves incentives and avoids cross-subsidization on average. Default is defined as the surplus becoming negative at any time. We introduce infinite horizon default probabilities for both standalone and pooled accounts. Using a thinning construction, each individual claim process can be represented in terms of pool arrivals with either zero losses or positive losses. A convex order argument then shows that allocated losses are less variable than standalone losses in the risk-averse sense. This leads to a central result. For any initial deposit, infinite horizon default probability is always smaller with pooling than without pooling. In other words, from a long-run solvency perspective, pooling is unambiguously beneficial for every participant. Over a finite horizon, default probabilities are defined up to a fixed maturity. When the initial deposit is zero, Takacs-type formulas provide explicit representations in terms of stop-loss expectations. In this case, pooled default probabilities exceed standalone ones. Intuitively, without deposits, ruin is driven by very early claims, and pooling increases the frequency of contribution calls, which raises short-term default likelihood. This result highlights the fundamental role of initial capital. Pooling improves long-run risk, but may worsen short-term solvency unless participants bring sufficient deposits. This clearly separates timing risk from ultimate risk. Timing risk is captured by the largest excess of claims over contributions. Both over infinite and finite horizons, pooling reduces these excesses in stochastic or stop-loss order. Moreover, at any fixed time, pooled account values dominate standalone values in convex order. This means that every risk-averse agent strictly prefers the pooled account distribution at all times, even in situations where finite horizon default probabilities may appear unfavorable. For a numerical illustration, we simulate heterogeneous claim frequencies drawn from a gamma distribution with identical exponential severities. In this setting, the sharing rule becomes proportional. Each participant pays a fixed fraction of every loss. Closed-form expressions are available for infinite horizon default probabilities, while finite horizon probabilities rely on classical Bessel function formulas. The numerical example illustrates crossings of default probability curves as initial capital varies, confirming the theoretical findings on finite versus infinite horizon behavior. This figure plots default probabilities as functions of the initial deposit for different horizons. Over infinite horizon, pooling always reduces default. Over finite horizons, curves cross. For small deposits, pooling worsens default, but beyond a threshold, pooling becomes beneficial. This crossing reflects the tension between early timing risk and long-run diversification and provides a clear quantitative illustration of the theory. Let me now focus on the large pool regime. First point, in a sufficiently large community, the variance of the allocated cumulative loss for a fixed participant can become negligible. The intuition is that the pool receives many independent contributions of risk, and the conditional mean sharing rule dilutes each realized pool loss across participants, so their random fluctuation on a given individual account is averaged out. In section 5.1, the paper makes this precise by writing an explicit expression for the variance of the pooled allocated loss process and showing, under mild integrability, that it tends to zero as the number of participants grows. As a consequence, for any fixed time t, the pooled account value converges to a nearly deterministic linear trend. The drift corresponds to the safety loading part of the premium income plus the initial deposit. This is the formal statement behind full diversification of individual risk. To derive rigorous asymptotics for ruin probabilities, we state pool-level scaling conditions. This is assumption 5.1 of the paper, the aggregate claim intensity, and the aggregate premium rate scale proportionally with n. So the intensity per participant and the premium per participant converge to positive limits. In addition, the pooled severity distribution converges to a limiting distribution that is light-tailed, meaning its moment-generating function exists at least on a non-trivial interval. This ensures that, for large n, the classical adjustment coefficient exists and is unique. The individual level scaling is more delicate because the allocation depends on the pooled mixture density. Assumption 5.2 requires uniform convergence of the pooled density to a limit, and introduces a limiting tilted severity for participant I, built from the likelihood that I generated an observed pooled loss. The key requirement is again a light-tailed condition through existence of a moment-generating function. Under these assumptions, an individual adjustment coefficient exists for large n and converges to a limit. The takeaway is these assumptions formalize stability of the pool and make the large n diversification effect quantifiable. Now we use those assumptions to quantify how fast default probabilities decrease. At pool level, the adjustment coefficient is defined as the positive solution of the Lundberg type equation that balances premium rate and the exponential moment of the claim size distribution. Under technical assumptions, this coefficient exists for large n and converges to a limiting exponent. This is the standard light-tailed Cramér-Lundberg regime. Proposition 5.3 of the paper gives the asymptotic form of the pool's infinite horizon default probability when initial capital grows. It is essentially a constant times an exponential term with rate given by the adjustment coefficient. A technical but important message in the proof is that Without extra regularity, one should not automatically replace the finite and coefficient by its limit inside the exponential. Convergence rates matter for refined approximations. At the individual level, we shows an even stronger phenomenon. The participant's infinite horizon default probability inside the pool behaves like a constant times an exponential term whose exponent is proportional to n times the participant's deposit. In other words, for a fixed positive deposit, ruin probability decreases exponentially fast as the community grows. This formalizes the almost complete diversification of idiosyncratic risk. The paper also treats finite horizon asymptotics under the scaling where capital per participant converges. We provide refined large deviation type equivalence with a rate that depends on the ratio of horizon to capital per participant. There are two regimes separated by a critical threshold, and the approximation includes the usual square root prefactor typical of saddle point methods. Practically, large pools reduce risk strongly, but finite horizon behavior still depends on the timescale relative to capitalization. Let me conclude with the operational extensions, which matter when we insist on paying claims at occurrence time. When the pooled surplus becomes negative, the pool borrows the deficit and pays interest at a constant force. The interest cash flow is proportional to the current deficit, so it directly prices timing risk. Claims arriving too early create temporary financing needs. To allocate this interest burden, the paper imposes a no sabotage monotonicity condition. The idea is that conditional expectations of individual accounts should move consistently with the pooled account. No participant should benefit, on average, when the pool deteriorates. Under this condition, the aggregate interest payment admits an additive decomposition into participant-specific components expressed via conditional expectations, either of individual surpluses given the pooled surplus, or of individual cumulative claims given the pooled cumulative claims. The practical output is an additional contribution rate for each participant, computed from these conditional expectations, while keeping the baseline risk-sharing mechanism unchanged. At maturity, the same philosophy is used to share terminal surplus or terminal deficit under the same monotonicity requirement. Participants receive bonuses when the terminal surplus is positive, or pay extra contributions when the pool ends in deficit, again through conditional expectation-based allocations that preserve coherence at the collective level. Finally, we explain how an insurer can layer optional guarantees on top of pure pooling, for example to cover the time in red deficit or the terminal deficit, thereby separating diversification within the pool from price protection products. This closes the loop between a mathematically tractable pooling mechanism and realistic insurance program design.